And on today's show, how proactive planning interfaces with tax bracketology. Part 5 of this week's series on end-of-the-year income tax planning for 2014 with top producers Mike Kilbourn, CLU CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Welcome to the show, Rob.
Good to be here.
Mike, 5 days with Steve Savant. I got to tell you, we're talking about everything that's taxes, and today we're into, I thought, when you first sent me this, I thought it was the NCAA brackets and the way you do your format, because you know it has some similarity because your software that you've developed here is not linear.
No.
This is a pictorial, almost dimensional way of looking at things. When we're looking at tax brackets, I'm sorry, but when I go out to the web, they say we're in a progressive tax system. Oh, it's called a marginal tax system. Oh, it's the effective tax bracket, your average tax bracket. Yeah. What page are we on? So hopefully after this segment, we can get a little bit of technology on bracketology.
Sure.
So let's walk through it. And now we know that you were remarking earlier in the week, the end of the Bush era, those taxes, it just went the way of the dodo. They're gone.
Right.
But that created 7 new brackets. And actually, I'm still stunned. I'm 3 days back when you said, Mike, that we have 4 new brackets on capital gain because I forgot about that 18.8. Right. Unbelievable. I think that's a revelation. That's going to be a revelation. If you missed that show, you need to go back. I think it was Tuesday or Wednesday. That revelation alone would make people want to come to their client in front of them before the end of the year and start talking this way. So talk to me about your creating 7 new tax bracket and what you call bracketology.
Bracketology. Well, it looks like this. What happened in January 2nd, 2013, and these are the tax brackets that were introduced starting for 2013, 14, 15, and until further notice till they change. And there will be some indexing here, but you can take a look at the 7 brackets that we now are playing with now. And so you have the single, married, head of house, married filed separately, but most people will focus in on the single or a married couple. And you kind of see where the incomes, where it leaves off. So up to a married couple, up to 72.5, they're still in the 15% bracket. And that's very important. Why? If they sell some stock and it goes up in this bracket here, they pay 0 tax on it.
And we were talking about this earlier, about actually maximizing the lower brackets, because some people are saying, I pay no tax. And you say,
no, it's not good, not at all.
It's not good.
Yeah, there's opportunity. When I see a 0 tax dollar figure liability, there's opportunity.
You know, I think the end game, I think most of our consumers, if they're peeking in on our show, they're going to say, what, I thought the 0 tax was the zero-sum game.
No, you're losing opportunity to fill up brackets in here. Okay,
so let's talk about that just for a second, because we're talking bracketology, so might as well stay there. So I have a 10% and a 15%. You're saying, listen, if I wanted to convert a Roth would be a perfect example of this.
Exactly.
Yes. I could use the headroom that's in here. I've heard people use this phrase bracket bumping. Is that the
I've not heard that, but I can understand what it means. Sure. They're just filling up the brackets.
They're just filling up the brackets.
Correct.
Yeah, I think a senior has like $22,700 in their exemptions, or whatever that's free.
Right.
Then the next piece of money, this block of money, is going to be worth 10% tax and 15%. So you really are into, I don't want 0 tax. I just want to pay enough tax to do some really creative things.
Exactly. That can make big impact down the road 10, 15 years or future generations. So knowing the tax brackets, and this is taxable income, not adjusted gross income, which are 2 different things, which is different than modified adjusted gross income.
Well, just give me the yin and the yang on that for a real quick second.
Right. So adjusted gross income is what's on the bottom right of your 1040 file over here. Yes. They throw certain deductions back in, and that equals modified adjusted gross income. This is taxable income. This is on page 2 of your 1040. And so we want to be careful there, is you might have someone who has over $250,000 of adjusted gross income, and all of a sudden now they're in this surtax, but with deductions and exemptions, their taxable income they're still in the 25% bracket. And so there's a lot of moving parts that advisors need to be aware of now, probably more than ever before.
When I'm looking at this top bracket, because you said after the Bush sunset, tax sunset, this whole new bracket was created. Mike, you live in the affluent clients at the highest level.
Yes.
Well, that number, and that's just the federal, right? That's not even state.
That's not state, and that doesn't count something we're going to talk about a little bit later, which is the net investment income tax.
And we get into that in the second segment here. We're going to come right back to you on that. But Mike, 39.6. A lot of your clients are in this topped out. We call it. 39.6 doesn't sound marginal to me. That sounds like a big number. Your defense against income. I mean, you guys do a lot of business together. How do you pull that number down?
Oh, that's a tough one. And so what we do is we try to show them how they can increase the deductions, take advantages of certain techniques in estate planning that will help them.
And a lot of charitable giving. You guys
charitable giving is a key part of that formula. So we might do a charitable remainder trust and use the deduction to create that. And they still get an income as a result of that, creating that vehicle.
One of the things we do is a tax diversification. A lot of advisors focus on investment diversification. Tax diversification is very important. And so you have different types of accounts. You have taxable accounts and tax-deferred or tax-free accounts. So those who have taxable accounts, you'd want to put things like an index fund, which has low portfolio turnover, municipal bonds, life insurance cash value, and immediate annuities. Those with tax inefficiencies, meaning high portfolio turnover, high yield bonds, covered call strategies, put those in deferred accounts. To save on taxes.
So I just want to, before we go to the break, I want to understand your thinking though, because you just said something powerful. You know, we look at investment portfolio for diversification. We're doing things that are hedging and some of our positions, and we're trying to look at something that's balanced. But now we're talking about tax diversification. Tax deductible, tax deferred, tax free, all these things that have a play, and how does it affect maybe Social Security and all these things?
And where you place those investments into which accounts. And the last thing before we go to break is tax arbitrage. And this is something for people who have clients with higher incomes, they need to be thinking about avoiding and deferring, such as Mike mentioned, charitable giving, like the charitable remainder trust, retirement plan, and tax cross-selling. Those in the lower brackets, under 25%, are talking Roth conversion and gain harvesting. And so an advisor needs to know tax diversification combined with tax arbitrage strategies can have a powerful result for their client.
We come back from the break, we're going to be all over this tax bracketology and look at a whole new area that Mike wants to address. It's going to be huge. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with Rob O'Dill and Mike Kilbourn. We're talking about tax bracketology. It's a whole new thinking and a whole new mindset. And we looked at the brackets and the 7 that were created post the Bush sunset years. Now we're talking, walk me through a little bit of this, and then let's talk about the big one that Mike wants to jump all over because he lives in this land.
Well, starting in 2013, there was a new net investment tax that came into play. And it started January of 2013, and it's on taxes on investment income over certain thresholds.
And the thresholds, of course, are $200,000 for individual and $250,000 for married filing jointly. And the good news is that's not, well, maybe it's bad news. I guess it is bad news because it's not indexed for the future. So anytime you get over these numbers, you're stuck with another tax, and that tax is the 3.8% net investment income tax, or the Obamacare tax, or the Medicare tax, whatever you want to call it. And the truth is that pushes, like my clients, they're not in the 39.6% bracket, they're in the 43.4% bracket because they're up there with the income and they almost always have net investment income.
Let me make sure I got that right now. So they're already at the 39.6 ordinary income federal level.
Yes.
Adding on now to your 3.8.
43.4, add the state, and it keeps creeping up. And then there's the phase out of some of their exemptions, the Ps and the PEP phase outs we talked about in an earlier session. In any event, you've got your 3.8%. What is it? It's a tax on net investment income as long as you're over a certain level, and that again, it's 50.
It's adjusted gross income. Remember that now. That's the front page. That is so you have adjusted gross income for a married couple of 250. They might give a lot to charity, but that does not reduce the adjusted gross income. It reduces taxable income, and so they would be subject to this tax. So now, what this is a tax on? The most common things are realized capital gains, distributions from mutual funds, dividends and interest, rents and royalties. What's not on is annuity interest, muni bond interest, sales of personal residence, and earned income.
And on the sale of personal resident, up to the cap. The cap is, if 250,000 a husband, 250,000 wife, that's 500,000. But if your gain is higher than that, unfortunately, guess what? Big surprise, 3.8% of that figure above the exempted amount.
And if I heard you correctly, Rob, you can't give enough money out the door to escape that.
No.
Right. Did I just heard that right?
Because it's adjusted gross income. It's on that first page of that 1040, 250,000.
So it got you.
So we have clients who are in the 25% bracket but are subject to this tax because they have a higher adjusted gross income, they give a lot to charity, they have a lot of mortgage interest deductions, state income tax deductions, and so their taxable income is relatively low, but they're subject to this tax.
So they're 28.8 in that case because it would have the 3.8 added on to their bracket.
I have to say, and I just want to say this, I don't think most of us think in this secondary tax, because I'm thinking I'm in the 25% tax bracket. That's my top-down marginal bracket. I don't. Why would I be subject to that? I thought that was for the people who had earned income over $250,000 married couple.
Right. Right. I mean, it's deceiving, isn't it?
It's totally.
So now that's why tax diversification and tax arbitrage that we talked in the last segment on becomes vitally important. Where you place various assets becomes important because if you have a mutual fund that has high portfolio turnover, you might put that in an IRA because IRA distributions are not subject to this tax.
But I guess I'm just so stunned that the middle class could be paying that number.
They are.
It blows my mind.
Yeah.
A little side note on Obamacare. You know, I noticed that a lot of people are marking their credit. They're getting ready to take their credits for their premiums. I noticed an anomaly that most people are using the adjusted gross income number on page 1, but it's my understanding that the Obamacare tax credit is based on modified adjusted. Is that true? Did I get that right?
That's correct, yes.
Right. So
well, that's going to be a huge wake-up call because I think people are factoring on page 1 at the bottom and they're saying, I qualify.
There's a lot of throwbacks in
and
there.
They forgot the add-ons back on a modified. And by the way, just a little side note, am I wrong when I say there seems to be so many iterations of modified adjusted gross income? It's not one. It seems like there's several different iterations.
Yeah, they throw things back in. They raise that adjusted gross income up. So more and more people have a higher modified adjusted gross income than they do adjusted gross.
You're both playing with affluent clients. How do you defend against this?
Well, it's driving my clients a little bit crazy. I mean, they're really up in arms. Maybe it was reflected in the recent elections, but this is we wonder what the future holds. I mean, you think about how complex the tax code was before 2012. I mean, and now look at where we're at with this.
Well, this is where tax diversification becomes very, very important. I mean, as an advisor, it's important the assets you have the asset allocation, but tax diversification, where you place those assets, and what do those assets throw off in terms of tax liability. Vitally important because we can have a major impact in protecting our clients.
I noticed we had another gentleman on who's known in the United States as a top-of-the-line retirement professor, and his line was, he bemoaned the fact that most of his clients have such a large volume of qualified money and hardly any non-qualified money, and you're stuck. Because you can't play some of the games, especially RMD, Social Security. He bemoaned the fact that there's not enough tax diversification. When you brought that up, I'm thinking, how many people think in that secondary dimension?
Right. And it really goes back to when they were in their earning years, is that there's such a seduction to put money into IRAs and 401ks because you get the immediate tax benefit, never thinking what's going to happen when they get in their 60s and 70s and 80s when they have to start taking that money out and pay ordinary income tax. So an advisor really needs to be cognizant of how much is a non-qualified and qualified and the relationship between the two. I probably spend more time talking to my retired clients on that and getting them to fill out the brackets to reduce the qualified amounts.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Miss an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you next week.